Hello guys, welcome back to Zodiac Trading. So today we're gonna talk about another big headline. We're gonna talk about Fitch downgrading the United States long-term rating from triple A to AA, which is double A and with a plus. And this is one of the big news because as far as I have remembered, this is the second time in the entire history that the U.S. long-term debt is being downgraded. So last time S&P downgrade the U.S. debt, and it was in 2011. So that was quite early because the S&P downgrade, you see, the first time it was in 2011, it was August the 5th. Okay, so back then, 2011, Standard and Poor, it was the credit rating was by Standard and Poor, and S&P removed the United States government from a list of risk-free borrower, and the market resulted in great crash that day. So the S&P was trading down, and so a lot of people are feeling worried about the U.S. debt market. The people are really worried about the entire credit system of the U.S. market. So back then, the S&P, their view was the downgrade reflect the S&P's view that the effectiveness, stability, and predictability of American policymaking and political constitution have weakened ongoing physical and economic challenge. Okay, so that happened in 2011, and this time uh, now is 2023. After 2020, we see another uh, default rating, and we see another downgrade. So we're going to first look at what the Fitch really said about the entire downgrade thing, and then we'll be looking at what Janet Yellen actually believed, and I will talk about a little bit of my view on the entire credit event thing. Okay, so this is from the Fitch rating page. So they're saying the reason why they put a downgrade on the U.S. debt is because based on several things. First of all, would be erosion of governance. Okay, so that actually in Fitch view, they believe that in the past 20 years of governance, they believe that the U.S. government, the fiscal and debt matters, they see a deterioration, and especially the debt limit ceiling thing. They this is what they say: the repeated debt limit political standoff and last-minute resolution have eroded confidence in fiscal management. In addition, the government lacks a medium-term fiscal framework, unlike most peers, and has a complex budgeting process. That I think is quite true, and I will share about my view on this later. But now let's just focus. So additionally, there has been only limited progress in tackling medium-term challenges related to rising Social Security and Medicare. And the second reason is because the rising general governance deficits. So the Fitch expect the general government deficit to rise 6.3% of GDP from 3.7% in 2022, and reflecting a cyclically weaker federal revenue. So it's all more of the revenue. You have less income, less federal income, but with more spending. So the new spending initiatives and high interest burden. Additionally, state and local governments are expected to run an overall deficits of 0.6% of GDP this year, after running a small surplus of 0.2% of GDP in 2022. Okay, so cuts to non-defense discretionary spending, 50% of federal spending as agreed of Fiscal Responsibility Act. And because of these number, I would just skip the most part. of this point because just a lot of numbers showing that the federal government is running on more budget with less income. Okay, the third reason is about the general government debt to rise. Okay, so the U.S. government has lower deficits and higher nominal GDP growth and reduced the debt to GDP ratio over the last 2 years from pandemic high 122%. So, however, at 112.9% this year, but still above the pre-pandemic level. So that in that case, they believe the debt to GDP ratio hasn't been lower as quickly as the market, as it should have. So the government debt to GDP ratio is projected to rise over the forecast period. So which is reaching around may reach about 120%, 118% 118.4% by 2025 to be precise. So the debt ratio is over 2.5 times higher than the triple A medium of 39.3% of GDP and double A medium of 44.7% of GDP. Okay, so based on that, they believe there would be a downgrade. Okay, the fourth point is the medium-term physical challenge unaddressed. This is more of the unforeseeable risk and black swan thing. So over the next decade, high interest rate. So it's more about the effect of raising interest rate and the rate when you are raising the interest rate, they will bring certain burden and impact to the economy situation and economy system. So also they are talking about the aging population and rising healthcare cost. So and that's going to elderly absent that is going to result in a downgrade because that reform is going to create burden to the U.S. economy. Okay, so the CBO has also estimates of rise in mandatory spending on Medicare and Social Security by 1.5% of GDP. And additionally, the 2017 tax cuts are set to expire in 2025, but there is likely to be political pressure. Of course, if you're talking about tax, there will always be political pressure. Okay. And the fifth reason is exceptional strength supporting ratings. So Fitch believes there are several structural strength underpinned under United States rating. So large, advanced, well-diversified, and high-income economy supported by dynamic business environment. So this one they still see as a strong economy, but the rating is not as strong as it used to, and the economy might just slip into recession. So that means tighter credit conditions, weakening business investments, slow down consumptions. Um, they're going to see because the raising interest rate going to create impact to the economy. So I expect people taking more or less. People are taking less leverage, so there will be less loans, and there will be greater chance for the economy to slip in the recession. The Fed tightening. So in March, Fed raised interest rate by 25 basis point, May and July. So Fitch also expects one more hike by September. So and they indicate that the labor market, the resilience economy, and also the labor market is going to bring difficulties to Fed's goal because the Fed's goal is to bring down that inflation back to 2%. And right now, the headline inflation fell 3% in June, and core PCE inflation, which is the key price index, remains stubbornly at 4.1%. I also agree with this because Biden administration is playing this dangerous game because they're just trying to tell you because the headline inflation fell. That's why just ignore the PCE inflation, even though the PCE inflation is still trading at 4.1%. So they're just creating a facade that you should bring compliment and you should support the Biden administration. What? Are you like going to call Biden as a king or emperor that every decision you make is right? No, we are not seeing inflation going back to 2%. So we expect the interest rate not going to be easing so fast. So this will likely prelude cuts in the federal fund rate until March of 2024, meaning next year. Um, so additionally, the Fed is continuing to reduce the holding of MBS and treasuries, and that will bring a tightening financial conditions. As I have mentioned before, the repo crisis thing, the bond market liquidity thing. Okay, and also the ESG. They talk about the ESG. So U.S. has an ESG relevance score, RS, for 5, stability, political stability and rights. So the rule of law, institutional, regulatory quality, control of corruptions. And right now, Fitch proprietary sovereign rating model and U.S. has high ranking at 79, reflecting well-established rights, blah blah blah, low-level corruption, rating sensitives, factors that could individually collectively lead to negative rating action through downgrade, public finance, so increasing government debt, macroeconomic policy performance most related to the Fed and the reserve currency status of US dollar, and a factor that could individually collectively lead to positive rating, blah blah blah. So this is basically what they are saying, the reason why they are downgrading the entire US debt market. And right now we're seeing here the best of worst case scenario thing. So what they believe the complete span of best worst case scenario credit rating for all rating categories, rank from AAA to D, best worst scenario. You could just watch the site. So I guess that's everything that the Fitch rating has been saying. So right now I'm just going to share a little bit of what I have believed, what I believe with the mis and wrongdoing of Biden administration. So there are 4 things in general. Okay, first, it will be the debt ceiling thing, because the debt ceiling thing, you cannot expect when someone borrows money, they pay off their debt. Right now, a debt might be a good thing for monetary expansion. Like sometimes you need more debt, sometimes you need a little bit of leverage to stimulate your economy because people will borrow more money, people create more jobs, and by that the economy forecast become positive. People have very high risk tolerance. People gonna borrow more money, making more profits, creating more jobs. But right now, at the moment, we don't see that kind of circulation. We're actually seeing the debt amount has increased to a very high level, which is currently debt to GDP ratios around 120%, and that's a scary level. You don't want to end up like Japan, right? And the second thing is about the political instability. Most is between the Biden administration and also Republic. Okay, so in the previous video I talked about the debt ceiling thing should be canceled, and people should, the politicians should stop using this as a tool to create such unforeseeable risk in the financial market. But you need certain mechanism, maybe not the debt ceiling mechanism, to stop the debt from exploding. On the other hand, the Biden administration aggressive monetary expansion package actually creates uh, a large amount of inflation. So on the other hand, they always blame everything on the Ukrainian-Russian war. But in reality, I think Biden's administration is also should be blamed for creating such inflation. Third, it would be the bond market fragility. Because right now, as I have mentioned before, in 2019, there was a repo crisis. So you end up finding a financial system not capable and not having sufficient liquidity. Because people, what happened in 2019 is because you have a more of restrictive monetary policy. In the same time, you have shrinking balance sheet, and then you have companies taking out cash from the system, and then you're seeing these liquidity dried out in the repo market. And hence why that is creating instability to the bond market. And that's why if you are having a bond market liquidity crisis, the Fed should step in and by printing more money. Okay, so that is something we're going to look at. And the fourth, by that I mean Biden always trying to portray himself as a hero who tamed inflation back to 2%. As I have mentioned before, right now the PC is still trading at 4%. It's still at 4%, 4.1% to be precise. And the target is at 2%. But then every time you keep mentioning about the headline inflation, just got me, it's not the big like um, and also the physical. I think the Treasury head Janet Yellen also says that he says the economy is going to be well soon, and I highly suspect that because with that inflation, you don't know if that job wage growth, if that's resilient, and it could bounce back. Okay, and then if that bounce back, it just create another inflation, and if that's stubborn, you have a great chance for you to enter that hard landing scenario or recession scenario. So what really happened with the Janet Yellen, which actually says that Janet Yellen actually believe uh, on the Fitch thing, she believes that Fitch rating downgrade is out of date, using the wrong data. Generally disagreeing with the entire Fitch downgrade thing. So she said, I strongly disagree with Fitch rating decision. The change by Fitch ratings announced today is arbitrary. He might the words arbitrary and based on outdated data. Fitch quantitative rating model declined markedly between 2018 and 2020. Yet Fitch is announcing its change now, despite the progress we see in many indicators. Okay, so whatever. So in today's episode, I've shared my view towards the Fitch rating cut thing, and I wonder what you guys think about. If I don't know if what you're believing. Do you actually believe the U.S. economy is not going to have a hard landing, or you believe the U.S. market is going to have a hard landing? Let us all debate and also communicate in the comment section. So please subscribe and share my content. Thank you guys for supporting my channel. So I will see you soon. Bye.